Grayscale has lost the confidence of crypto investors, or at least that's what the market's telling us following the launch of Bitcoin ETFs. Well, names such as the dreaded BlackRock and Fidelity have pulled in a combined $1.2 billion in flows. Grayscale has instead seen a rush for the exit. Perhaps investors want to place their money with a more trusted household name. Or maybe the drama surrounding Grayscale's parent co, DCG, has people nervous about their investments. But what's so special about the Bitcoin ETFs anyways, and how do they work? In today's video, I want to explain this. Let's dive in. Before delving into the distinctions between Bitcoin ETFs and regular ETFs, let's bring you up to speed on what ETFs are and how they operate. To begin, ETF stands for Exchange Traded Funds, reflecting their nature as funds traded on exchanges. Typically, these funds focus on specific sectors and exclusively invest in companies within that sector. Consider Vanguard's Dividend Appreciation ETF, for instance. This ETF tracks the NASDAQ US Dividend Achievers Select Index, which offers exposure to dividend-paying large-cap companies, holding 314 companies with the likes of JP Morgan, ExxonMobil, and Costco among the largest. These companies collectively form the essential building blocks of the ETF. Now, by buying shares in a single ETF, the companies that are within that ETF effectively make up a portfolio you can own. In a way, you're eliminating the need for hiring your own portfolio manager or your own advisor. Now that we've covered the basics of ETFs, let's explore their workings, where a multitude of individuals and entities operate behind the scenes in an effort to grab some cash. For simplicity's sake, we'll focus on two key groups: the fund managers and the authorized participants. These APs play pivotal roles in creations and redemptions, integral processes in the ETF ecosystem. Now, you might be wondering, what exactly are creations and redemptions? Typically, these events occur when there's a surge in buying or selling of shares in the ETF. And these can be done in two ways, either in kind or just the exchange of cash for new shares. In kind creations involve APs, who act like architects assembling the building blocks. APs submit a list of these building blocks, referred to as a creation basket, to the ETF issuer. In return, the APs receive new ETF shares, essentially trading a set of building blocks for a share of the entire structure. On the other hand, when it comes to redemptions, APs play a crucial role again. In this scenario, APs can be seen as deconstructors, dismantling or modifying the ETF structure. They submit a redemption basket, a list of building blocks they want to remove from the ETF, in exchange for ETF shares. The ETF then gives back the equivalent value in assets, providing the APs with the original building blocks they contributed. Alright, so if you're watching this video, you're wondering about Bitcoin ETFs. How are they any different? Beneath the surface, these new Bitcoin ETFs operate as trusts, overseeing pools of Bitcoin and issuing shares. Now, this created a bit of a problem with the SEC. When the concept of a Bitcoin ETF first surfaced, the filings revealed a preference for in-kind creations and redemptions. However, the in-kind model triggered regulatory concerns, sparking focused discussions with the SEC late last year. The apprehensions arose from the fact that authorized participants, integral to the process, are registered broker-dealers in the US stock market, and existing regulations do not permit broker-dealers to handle cryptocurrency. By December, a noticeable shift occurred. All asset managers aiming to launch Bitcoin ETFs transitioned to a cash model. This model eliminates the need for authorized participants to physically handle Bitcoin, as evidenced by regulatory filings. Now, instead of authorized participants easily being able to do in-kind creations or redemptions, they're funneling cash from daily inflows to the Bitcoin ETFs. Interestingly, it's now the fund manager who bears the responsibility of buying or selling Bitcoin. You might wonder, where do these billions of dollars worth of Bitcoin find a secure storage location? Given the prevalent concerns about cryptocurrency wallet hacks, how can this process be considered safe? Here's the reassuring part. Most of the new Bitcoin ETFs have chosen Coinbase as their designated haven for storing Bitcoin. This involves stashing the digital assets in a dedicated account at Coinbase. While specifics about their storage methods remain undisclosed, it's widely assumed that they'll opt for cold storage wallets, offline locations with no internet connection for added security. Now, let's focus on the actual product, the 9 Bitcoin ETFs that received the green light and launched just last week. The anticipation and excitement surrounding the approved ETFs seems to have somewhat outpaced reality a bit. As of the time of recording, Bitcoin has already retraced under 41,500 US from a high of just over $49,000 when the ETFs first hit the market. In the initial 3 days following their launch, nearly $2 billion poured into these Bitcoin ETFs, at least on the surface. The winners here were BlackRock's iShare Bitcoin Trust and Fidelity's Wise Origin Bitcoin Fund, which drew in $700 million and $500 million respectively. We also have to quickly mention Bitwise and ARK Investments, who also have pulled in a couple $100 million. But not everyone's having a good time. Let's take Grayscale's Bitcoin ETF, for instance. This fund has been around for several years, structured as a closed-end fund, meaning it lacked mechanisms for redemption and creation that would allow the fund to closely track the actual value of Bitcoin. As a result, GBTC, as its ticker symbol goes, often traded at a significant discount to its net asset value, or the total value of its Bitcoin holdings. In contrast, the new ETFs by BlackRock and Fidelity are designed with features more characteristic of traditional ETFs, including redemption mechanisms, which help them more accurately reflect the price movements of Bitcoin. But unlike those more reputable names now in the Bitcoin ETF game, Grayscale instead experienced roughly $1.6 billion in outflows, which the company is blaming on investors locking in profits after Bitcoin's run. From their view, Grayscale, which converted from a Bitcoin trust to an ETF, is simply seeing investors lock in profits. This explanation is obviously trying to glaze over a couple of elephants in the room, such as the company's baggage with DCG, or the fact that they charge a 1.5% management fee, which is sometimes more than 10 times what the other ETFs are charging, with fees ranging from just 0.12% to 0.39%. So let's wrap it up. It's fair to say that overall, the Bitcoin ETFs have not been the savior the crypto dudes expected. Now, after factoring in the drawdowns at Grayscale, and there's more to be expected, the net inflows over the first 3 days of ETFs being approved for Bitcoin amounted to around $800 million. Well, many people in the crypto circuit are pointing to over $2 billion in inflows. Really, what's happening here is that for the most part, money is just largely going in a circle amongst crypto believers. But yes, there are some inflows. And the price of Bitcoin has dropped. It's currently down about 10% since just before the ETFs were approved. Fund managers likely expected more too. BlackRock advertised that its fees would be just 0.12% for the first $5 billion of assets under management. After its full week, AUM sits at just a hair over $1 billion. So it turns out that ETF approvals were not the catalyst Bitcoin and crypto bulls were praying for, or at least at this point. All right, everybody, thank you for watching. If you could do me a big favor, please smash that like button, subscribe, and ring that notification bell. Also, let me know what you think in the comment section.